You want to know what terrifies me more than another financial crisis? It's the retirement crisis that's unfolding right in front of our eyes. Every day at JPMorgan Chase, I see the data on retirement savings, and it's absolutely devastating. The average American approaching retirement has less than $200,000 saved. Using the standard withdrawal rules, that generates maybe $8,000 per year in retirement income, $8,000 per year. You can't live on that. You can't survive on that. But here's what really bothers me. It's not just that people haven't saved enough money. It's that even the people who have saved substantial amounts have built their retirement portfolios completely wrong. They're invested in assets that won't provide the income they need, won't protect them from inflation, won't last through a 30-year retirement, and won't give them the flexibility to handle the inevitable crises that come with aging. I've been managing retirement assets for over 40 years, first at other institutions, and now running JPMorgan Chase. We manage trillions of dollars in retirement money, 401k plans, pension funds, individual retirement accounts, endowments, family trusts. I've seen what works and what doesn't work when it comes to funding a multi-decade retirement. And I've learned that successful retirement portfolios aren't built around getting the highest returns or finding the hottest investments. They're built around owning the right assets in the right proportions. Most people approaching retirement make the same fundamental mistake. They think retirement planning is just an extension of wealth accumulation. They keep the same asset allocation they had during their working years, maybe shifting slightly more toward bonds, but fundamentally maintaining the same growth-oriented strategy. That's completely wrong. Retirement isn't just a different phase of wealth accumulation. It's a completely different financial challenge that requires a completely different approach. During your working years, you're adding money to your portfolio every month. You can ride out market volatility, and you can take risk because you have decades for investment to recover from setbacks. During retirement, you're withdrawing money from your portfolio every month. You can't afford major losses because you don't have time to recover, and you need income that you can count on regardless of market conditions. Today, I want to tell you about the 4 assets that every retirement portfolio must own, not should own, must own. These 4 asset classes form the foundation of every successful retirement strategy I've ever seen. Whether someone is retiring with $500,000 or $50 million, the principles are the same. The proportions might vary based on your specific circumstances, but these 4 assets are non-negotiable if you want a retirement that's both secure and comfortable. The first asset you absolutely must own for retirement is Treasury Inflation Protected Securities, or TIPS. Most people have never heard of TIPS, and even people who have heard of them don't understand how crucial they are for retirement planning. But TIPS are the foundation of retirement security because they're the only investment that guarantees to preserve your purchasing power over time. Here's the problem that TIPS solve: inflation destroys retirement income. Even modest inflation of 2% to 3% per year cuts your purchasing power in half over a 25-year retirement. What costs $100 today will cost $200 in 25 years with just 2% annual inflation. If your retirement income doesn't increase to keep pace with inflation, you'll be getting progressively poorer every year of your retirement. Most retirees learn this lesson the hard way. They retire with what seems like adequate income, but after 10 or 15 years of inflation, their standard of living has declined dramatically. They can't afford the same lifestyle they had when they first retired, and they certainly can't afford to handle unexpected expenses like major home repairs or increased healthcare costs. TIPS solve this problem because the principal amount adjusts for inflation every year. If you buy a TIPS bond with a $10,000 face value and inflation runs 3% that year, your principal adjusts up to $10,300. You also earn interest on that inflation-adjusted amount. So TIPS provide a real return above inflation that preserves and grows your purchasing power over time. At JPMorgan Chase, we recommend that retirees allocate 25% to 40% of their portfolio to TIPS, depending on their risk tolerance and other sources of income. This might seem like a large allocation to what many people consider a boring investment, but TIPS serve a crucial role in retirement portfolios that no other asset can fulfill. TIPS should represent the portion of your retirement portfolio that covers your essential expenses: housing, food, healthcare, utilities, transportation, the expenses you absolutely must be able to afford no matter what happens to the stock market or the economy. By covering these essential expenses with inflation-protected income, you create a foundation of security that allows you to take appropriate risk with the rest of your portfolio. Here's how to think about tips in practical terms. If you need $60,000 per year to cover your essential expenses in retirement, you should have enough tips to generate that income on an inflation-adjusted basis. At current yields, that might require $1.5 million to $2 million in tips. That sounds like a lot, but remember, this is the foundation of your retirement security. You can buy tips directly from the Treasury through treasurydirect.gov, or you can buy tips mutual funds or ETFs. At JPMorgan Chase, we typically recommend tips funds for most retirees because they provide diversification across different tips maturities and professional management. The second asset you must own for retirement is broad-based equity index funds. I know what you're thinking, stocks are too risky for retirement, but that's wrong. The biggest risk in retirement isn't market volatility, it's longevity risk. The risk that you'll live longer than your money lasts. And the only way to address longevity risk is with investments that can grow over time. Here are the facts about retirement that most people don't understand. If you retire at 65, you have about a 50% chance of living to 90 and about a 25% chance of living to 95. That means your retirement could last 25 to 30 years, not the 15 to 20 years that most people plan for. During those 25 to 30 years, inflation will cut your purchasing power significantly and your expenses will likely increase, especially healthcare expenses. If you try to fund a 30-year retirement with only bonds and cash, you'll almost certainly run out of money. Even with tips providing inflation protection, bonds alone don't generate enough growth to sustain withdrawals over multiple decades. You need the growth potential that only stocks can provide, but this is crucial, you need the right kind of stock exposure. This isn't the time for individual stock picking, sector bets, or growth stock speculation. You need broad, diversified exposure to the entire stock market through low-cost index funds. These funds give you ownership of hundreds or thousands of companies across all sectors of the economy, providing both growth potential and dividend income. At JPMorgan Chase, we typically recommend that retirees maintain 40% to 60% of their portfolio in equity index funds, depending on their age, risk tolerance, and other sources of income. This might seem aggressive for retirement, but remember, a significant portion of your portfolio is already in the safety of tips. The equity allocation is what allows your portfolio to grow over time and provide increasing income to keep pace with inflation. The specific equity allocation should include both domestic and international exposure. I recommend about 60% to 70% in U.S. total market index funds and 30% to 40% in international index funds. This global diversification protects you from the risk that U.S. markets underperform international markets for extended periods. Within the equity allocation, you should also consider dividend-focused funds. Companies that pay consistent, growing dividends tend to be more mature and stable, and they provide current income that can help fund your retirement withdrawals. Dividend growth has historically kept pace with inflation over long periods, providing another layer of inflation protection. The key with equity investments in retirement is managing sequence of returns risk. The risk that poor market performance early in retirement permanently damages your portfolio's sustainability. This is where the next two assets become crucial. The third asset you must own for retirement is real estate, specifically through real estate investment trusts or REITs. Real estate serves multiple purposes in a retirement portfolio. It provides current income through dividends. It offers inflation protection because rents and property values tend to rise with inflation, and it provides diversification because real estate doesn't move in lockstep with stocks and bonds. REITs are companies that own, operate, or finance income-producing real estate. They're required by law to distribute at least 90% of their taxable income to shareholders as dividends, which typically results in dividend yields of 3% to 5% or more. This income is crucial for retirees who need cash flow to fund their living expenses. But REITs provide more than just current income. Real estate has historically been one of the best long-term hedges against inflation. When inflation rises, rents rise, and when rents rise, the value of rental properties rises and REIT dividends rise. During the inflationary period of the 1970s, real estate was one of the few asset classes that maintained its purchasing power. At JPMorgan Chase, we typically recommend that retirees allocate 10% to 20% of their portfolio to REITs. This provides meaningful diversification and income without creating too much concentration in any single asset class. The specific REIT allocation should be diversified across property types and geographies. Residential REITs that own apartments and single-family rental properties, commercial REITs that own office buildings, retail properties and warehouses, specialized REITs that own data centers, cell phone towers, and healthcare facilities, international REITs that provide exposure to real estate markets outside the United States. One of the advantages of REITs over direct real estate ownership is liquidity. If you own rental properties directly, it can take months to sell them. If you need to access your capital, REITs trade on stock exchanges and can be sold immediately. This liquidity is important in retirement when you might need to access your capital for unexpected expenses. REITs also provide professional management and diversification that's difficult to achieve with direct real estate ownership. When you buy a REIT, you're getting exposure to dozens or hundreds of properties managed by real estate professionals. You don't have to worry about finding tenants, maintaining properties, or dealing with local real estate markets. The fourth and final asset you must own for retirement is short-term, high-quality fixed income securities. This includes treasury bills, short-term treasury notes, high-grade corporate bonds with maturities of 5 years or less, and money market funds. These assets serve as your liquidity buffer and your defense against sequence of returns risk. The purpose of short-term fixed income isn't to generate high returns, it's to provide stability and liquidity. This is the money you'll use to fund your living expenses during years when stocks are performing poorly. Instead of being forced to sell stocks at depressed prices during bear markets, you can draw from your short-term fixed income allocation and wait for stocks to recover. This is called the bucket strategy, and it's one of the most effective approaches to retirement income planning. You have different buckets of money for different time horizons. Short-term fixed income covers your near-term expenses. REITs and dividend-paying stocks provide medium-term income. Growth-oriented equity index funds provide long-term wealth building. At JPMorgan Chase, we typically recommend that retirees maintain 1 to 3 years of living expenses in short-term fixed income. So if you need $80,000 per year to fund your retirement lifestyle, you should have $80,000 to $240,000 in short-term bonds and cash equivalents. The specific allocation within short-term fixed income should be laddered across different maturities. Some money in treasury bills that mature in 3 to 6 months, some money in treasury notes that mature in 1 to 2 years, some money in high-grade corporate bonds that mature in 3 to 5 years. This laddering approach ensures that you always have money coming due that can be reinvested at current interest rates. The advantage of focusing on short-term, high-quality securities is that they're much less sensitive to interest rate changes than long-term bonds. When interest rates rise, long-term bonds can lose significant value, but short-term bonds are much more stable. And by focusing on high-quality issuers, the Treasury and investment-grade corporations, you minimize credit risk. Now let me bring all 4 of these assets together into a comprehensive retirement portfolio strategy. The specific allocation will vary based on your age, risk tolerance, and other sources of income, but here's a framework that works for most retirees. 30% to 40% in tips to provide inflation-protected income for essential expenses, 40% to 50% in equity index funds to provide growth and rising income over time, 10% to 20% in REITs to provide current income and inflation protection, 10% to 20% in short-term fixed income to provide liquidity and stability. This allocation provides multiple sources of income, multiple forms of inflation protection, appropriate growth potential for a multi-decade retirement, and the flexibility to handle various economic scenarios. During periods when stocks are performing well, you can fund withdrawals from your equity allocation. During periods when stocks are struggling, you can fund withdrawals from your tips and short-term fixed income, allowing your equity allocation time to recover. The key to making this strategy work is rebalancing. At least once per year, you should review your portfolio and bring your allocation back to your target percentages. This forces you to sell high-performing assets and buy underperforming assets, which is exactly what you want to do, but exactly what feels wrong emotionally. Rebalancing also helps manage sequence of returns risk. If stocks have a great year and grow to represent a larger percentage of your portfolio than your target, you sell some stocks and move the proceeds to TIPS or short-term fixed income. This takes profits during good times and builds up your defensive assets for when markets inevitably turn negative. Here's what a practical implementation might look like. You retire with $2 million. Based on the 4% withdrawal rule, you plan to withdraw $80,000 in your first year of retirement, adjusting for inflation in subsequent years. Your initial allocation might be $600,000 in TIPS, 30%, $900,000 in equity index funds, 45%, $300,000 in REITs, 15%, and $200,000 in short-term fixed income, 10%. The TIPS and short-term fixed income provide a foundation of security. The equity index funds and REITs provide growth and income. In years when your equity allocation performs well, you might fund your $80,000 withdrawal by selling some stocks and REITs. In years when your equity allocation struggles, you might fund your withdrawal by allowing TIPS and short-term bonds to mature, preserving your equity allocation for future growth. This approach has worked through multiple market cycles and economic environments. It provided adequate income and wealth preservation during the stagflation of the 1970s, the recession of the early 1980s, the stock market crash of 1987, the recession of the early 1990s, the dot-com crash of the early 2000s, the financial crisis of 2008, and the pandemic recession of 2020. But here's what's crucial. This strategy only works if you implement it before you retire and stick with it during challenging periods. You can't wait until you're already retired and markets are volatile to start building this kind of portfolio. You need to have these 4 asset classes in place, properly allocated, providing the income and stability you need from day one of retirement. The retirement crisis is real, but it's not inevitable. If you own these 4 assets in appropriate proportions, if you implement a systematic withdrawal strategy, if you maintain discipline during market volatility, you can fund a 30-year retirement successfully. But you have to start now. You have to build the portfolio correctly, and you have to stick with the strategy even when it feels uncomfortable. Your retirement security depends on it.